Welcome, everybody. I'm Rob Booker, and you're joining me on Tuesday, March 15th, 2011, for a special webinar called Wallaby Trade. It's an announcement for my new book, which was released just this week and is available now on Amazon.com. We're going to spend the next 60 minutes to 90 minutes talking about this trading methodology and answering your questions about it. The Wallaby Trade, just like any other methodology, carries risk. And trading foreign exchange on margin is not the safest way to invest your money. It may not be suitable for all investors, and the high degree of leverage can work against you as well as for you. And before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. And you should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. The Wallaby Trade was created in the lobby of a hotel in Australia. I was in Sydney, Australia about 5 or 6 years ago to do a seminar, and I thought about placing 3 stochastic oscillators on top of each other and then using those 3 stochastic oscillators all at the same time from one chart. And since I was in Australia, I named it the Wallaby and then kind of put it away and didn't use it a whole lot until the year 2007 when I visited South Florida to see a friend of mine, Roger. And Roger and I spent a week trading together and during that time, spent a lot of time talking about the Wallaby, and the origins of what you see today came out of those conversations. And here we are. I wrote the book in response to a need for more discussion about what divergence trading really is and what counter trend trading is. And it all turned out to be a fantastic discussion, not only about counter trend trading, but about trading with the overall trend as well. And that's where the Wallaby Trade is the most profitable. A lot of people talk about trading with the trend, right? That the trend is your friend, and that I've taken a lot of flack over the years for being a counter trend trader. Well, the Wallaby Trade is the first book or article or methodology that I've published that really answers the question: Can I do anything at all that trend trades? And the answer is yes. The Wallaby Trade does trend trade, and today we're going to talk about that. And like I said before, I'm going to repeat it like 900 times. The most profitable Wallaby trades come from trades with the trend, although it starts off as a counter trend methodology for reasons that we're going to discuss in a moment. The slides, the indicator itself are free. Hundreds of charts will be posted later on this week on the Wallaby Trade website. Lots of backtesting will be posted as well. And the only thing that's not free about the Wallaby Trade right now is the actual book. And it's about $10.08 on Amazon, and it will be $9.99 in the Kindle version when that is released very soon. So that's the only thing that's not free. And of course, I do want you to buy the book. Absolutely want you to buy the book. I'd love for you to buy the book. All right. We often hear things like trade with the trend, cut your losses, ride your winners, don't play the lottery, close the toilet lid, and, one of those staples from, your Sunday mornings in church, don't watch porn. You hear all these things, right? You hear this stuff, you listen to it, it's commonly spoken about, right? But what's the problem? Most people still don't ride their winners long enough. A lot of people still play the lottery. Most men don't close the toilet lid. It's kind of gross. And so we hear all these things that we're supposed to do, and trading is full of these kinds of comments. If you get on the message boards, you see those people that are constantly saying sort of the same things over and over, even in a frustrated tone, that say, they've been trading for 10 years and there still isn't a more important piece of advice than cutting your losses short and riding your winners. Well, I'm here today to say that Nothing that I'm going to tell you is groundbreaking. I might say it in a different way that you haven't heard before, but nothing that I'm going to tell you is so groundbreaking that you've never heard it before in your life. You know, there have been criticisms made of all educators and instructors on FX Street that they're telling you stuff that you can find out for free on the internet. Well, the fact of the matter is, this webinar is free, so you're finding this out for free on the internet. And also, that if it's so easy, why doesn't everybody do it? It's not easy, and some of the most simple advice really isn't ever followed. So with all due respect to myself before I start off this webinar, if you just cut your losses off and ride your winners more often, you're automatically going to be in a better spot, period. You're automatically going to be in a much better spot. I want you to be, as a trader, more like the mighty oak and stay firm and true to some set principles that are most important, and then give yourself a break on some of the other principles. And some of the stuff that doesn't matter is, which system do I choose? That doesn't really matter. There are hundreds of different trading methodologies that are going to work, and it doesn't really matter which one you choose. And I wrote a whole book about a trading methodology, and I'm here today to tell you that it doesn't really matter what trading methodology you pick. It doesn't make any difference at all. As long as you obey some set principles about money management, you're probably going to be okay. Most people don't follow those rules of money management. I also want to say that 2011 has been terrible for me. I've been a terrible trader in 2011. And I'm not here today to tell you that I'm a better trader than you. I'm not here today to tell you anything except for I'm going to share some principles with you, show you a trading methodology, but I'm going to be honest with you. My trading's been awful in 2011. And last night, actually, finally got myself back on track and took a great trade on the 15-minute euro dollar that we'll look at later. And it's sort of the start of me getting back on track for 2011. But most people aren't going to talk about their losses. Most people aren't going to tell you that their system doesn't work sometimes. And most people are so bored of the standard advice that they won't repeat it. None of those things are true in this webinar. Here's how to make yourself some substantial money. Do what works, meaning stop joking around and go back to what worked for you at the very beginning. Take advice from my grandpa that we'll talk about in a moment. Remember, if trading with the trend works better for you, then do it. Cut your losses, ride your winners, don't play the lottery. Here's what my grandfather told me when I would do something that didn't work. He'd say, "Little Willie, don't do that no more." And that's really true of myself in 2011. Getting back on track really wasn't about starting to do something. It was also about stopping stuff that wasn't working. Have you ever noticed that when you're in a slump as a trader, that you're not really in a slump, you're just sort of so disinterested in what you ought to be doing that you kind of experiment a little bit with stuff that you shouldn't? Well, my friend Scott brought that up with me the other day. He said, as a tennis coach, my players don't get into a slump. They get disinterested, and then they start doing stuff they shouldn't be doing just to stay interested, and those are dangerous moments. All right. What is the Wallaby? Once again, the Wallaby is a combination of 3 stochastic oscillators. It's not the Holy Grail. It's not invented by Jesus or the apostles or anything like that. And yes, I am still little. Here's Wallaby version 1.0. Wallaby version 1.0 was a bunch of wiggly lines on the bottom of a MetaTrader screen or a TradeStation screen. And each one of those lines that you see there in that square blue area is a stochastic oscillator from one time frame chart. Here's Wallaby version 1.5. I took those 3 lines and averaged them and then put a thick, dark, black line on the chart to make it a little bit easier to see. And then Wallaby version 2.0 is just that average line. That is the average reading of 3 stochastic oscillators, one from the 1-minute chart, one from the 5-minute chart, and one from the 15-minute chart. Here's what you need on your charts to follow what we're going to do today. You need some moving averages, you need a stochastic oscillator, and you need the Wallaby indicator. I'll show you what those moving averages are and what that stochastic oscillator is right now. The 800 simple moving average is black and white. It's my favorite moving average. The 200 simple moving average is blue. The 62 exponential moving average is red. The Wallaby indicator is black, and it's in the middle there, and it's set to 733. And the stochastic oscillator is set to 30, 10, 10. All right. The Wallaby indicator is viewed on one time frame chart. You already probably knew that, meaning you put the Wallaby indicator on, let's say, your 15-minute chart. If you put on your 15-minute chart, you'll be looking at the stochastic oscillators on your Wallaby indicator from 3 time frames, all on that one 15-minute chart. And we're going to take a look at that in a few moments, but that'll start us off. All right. What is divergence? Divergence is when price goes one way and your oscillator goes the opposite way. So if price is moving up, but your oscillator is moving down, that, my friends, is divergence. Here's an example of bearish divergence. Price is moving up on the picture in front of us here, but the Wallaby oscillator indicator is moving down. What that means is the average of 3 stochastic oscillators from 3 different time frames is divergent against price. And that's more powerful than if just one stochastic oscillator from one time frame chart was showing divergence. Why do I use the Wallaby instead of the relative strength index or the CCI or something like that? Although the Wallaby oscillator indicator will show divergence at the same time as the CCI and the RSI and other oscillators, the momentum indicator and so forth, it is true that the Wallaby indicator, because it's showing 3 time frames all at once, will often show divergence when another oscillator will not. And so it will get us into trades sometimes when we want to be in one and would not have otherwise seen the divergence. It's also true that sometimes the Wallaby will not show divergence when another oscillator will show it. Want to avoid the trade, and we do so because we've seen it on the Wallaby. Divergence is also when price is moving down and the oscillator is moving up. That's bullish divergence, and here's an example on a chart. Bullish divergence in this instance is when price is moving down, but the Wallaby is moving up, and it's an early warning sign that this currency pair may turn around and go up. And it's only an early warning sign. It's not, obviously, a guarantee. Here's an example of what a Wallaby trade looks like from February 28, 2011. On the far right-hand side of this chart, you'll notice that price is moving upwards, and I've drawn a trend line across the top of those candles. And the Wallaby oscillator is dropping. It's making lower highs across the same time period. You can see at the far right that the stochastic oscillator set to 30, 10, 10 is crossing over, making a bearish crossover on the right-hand side of the chart. And that is the entry on a Wallaby trade. Let's take another look at this and show you what the stop loss would be. The stop loss goes above the recent highs, and it's a tight stop. In most cases, this stop loss will be at least 2 times smaller than your profit target, and in some cases, much smaller than that. So that's where the stop loss goes, as tight as possible. And the profit target can be a recent low, can be a set of moving averages, can be a trailing stop. What I'm going to talk about using today is the 200 period simple moving average or the 800 period simple moving average. Both of those are my favorite profit targets for this trade. All right, let's go down here. See what questions. Auto coloring the candles green, red. Good question about auto coloring the candles. This is a stochastic paint bar indicator for MetaTrader that paints my candles red when the stochastic oscillator is overbought and paints my candles green when the stochastic oscillator is oversold. And I will absolutely positively make this indicator available on the FX Street website and also on my blog that we'll talk about later. So you can have that for free as well and download that indicator, which is helpful and shows you at a glance. Philip asks an interesting question. Why does his Wallaby only have 733, but sometimes my chart has 733, and then it lists 1560 and 240? Okay, that's an excellent question. There's an updated version of the stochastic Wallaby that will show you right in the window what time frame charts your Wallaby indicator is set to. And we'll make sure that most recent version of the indicator is available and uploaded to the FX Street webpage and also the blog. K6 Chris asks a very important question. Do the three Wallaby time frames start with the lowest chart time? Yes, that is absolutely true. And we spend a moment on this in just a little while. And I'll go over that exact formula for you in just a moment. In fact, I'm going to move over here and talk about setting up the charts. All right. Actually, why don't we pause for just a moment? This is a perfect stopping point on the introduction to the Wallaby trade. Let's pause here for a moment. Get your questions ready. This would be a perfect time to end part one of the video. And then what I'm going to do is pull up the slide that shows the actual time frames setting up. All right, that's just going to take a moment. Got some questions coming in. Keep them coming if you've got any questions. All right, let's see what questions came in here. What do I use to establish the direction of a higher time frame trend? All right, I'm going to go through some of these questions now as we're waiting for the presentation to come over. I simply look to the left of the chart, Chris, and nothing more complicated than that, and I simply look and say, has been rising or falling off to the left. And that has worked perfectly fine for me. The last chart had divergence on the stock, but not on the Wallaby. Would the Wallaby lack of confirmation have overruled? Paul Volcker, we'll have to go back to that chart in a moment and answer that question. Swerve, the plumber, asks, what do I attribute my recent trading challenges to? That'll be the subject of another webinar. KC asks, do you trade the lowest time frame of the three used for the Wallaby? 30, 60, 4-hour traded on the 30. Yes. Yes, if you're looking at the 1 minute, the 5 minute, and the 15-minute chart, you would trade from the 1 minute or the 5 minute. Yes. What's my favorite time frame for this indicator? It's the 15-minute chart, no question. All right. Nico says, what percentage profitability does the Wallaby trade have? I'll show you the testing that I did on the 15-minute chart to give you an idea of that in just a moment. We'll be looking at that today. See what else we got. Mentioned earlier that I have a few favorite pairs for the Wallaby. The euro dollar is number one on that list for me. Absolutely. The dollar yen is my next favorite pair for the Wallaby. And the pound dollar is my next favorite pair after that. All right, now we've got this back up here. And let me share my screen again. All right, let's begin part 2 of this presentation, and I'm going to talk about setting up the time frame and go from there. I should be showing now my presentation once again. If I were a short-term trader, input number 1 on the Wallaby would be the 1 minute. Input number 2 would be the 5 minute. Input number 3 would be the 15 minute. And then I would watch the 1 or 5 minute charts for trades. If I were a medium-term trader and I wanted to open at a maximum like 4 trades per week, input number 1 would be the 15 minute. Input number 2 would be the 60 minute. Input number 3 would be the 4 hour or the 240 minute, and then I would watch the 15 minute charts for trade opportunities. Long-term traders could look at the 60 minute, the 240 minute, and the 1,440 minute, and that's the daily chart, by the way. And then you would watch the 60 or the 240 minute charts for trade setups. All right, so that answers or should answer the question of time frame charts. My favorite is the 15-minute chart. And you have to remember the longer time frame charts mean wider stops and wider profit targets and a longer time between trades. So if you look at the 1 minute, the 5 minute, and the 15-minute charts, you could have 2 trades every day. And if you look at the 15-minute charts, you could have 2 to 4 trades per week. And if you look at the higher time frame charts than that, you could have at most maybe 1 trade a week, but maybe even fewer. All right. The short-term input, again, is 1 minute, 5 minute, and 15 minute. Remember that counter-trend trading can be frightening. It can be scary. It can, cause you a lot of pain and worry. There's a scary picture for you to remind you of how scary counter-trend trading can really be. It can also be profitable. Remember, anything that we're going to talk about today applies to trend trading as well. All right. Here is recent movement upwards. You see this on a 4-hour euro-dollar chart. The currency pair is moving up, and it's clearly a trend upwards, and it's a 4-hour chart, so it's over the course of a really long period of time. And you can see in all of these different areas, 1, 2, 3, 4, there are very slight pullbacks in each of those areas. So even though the pair is moving upwards during this time, there are very slight pullbacks during points 1, 2, 3, and 4. What's interesting is that inside of each of those circles on a short time frame chart was a Wallaby trade going up. And that's how I can trend trade with the Wallaby. And we'll look at examples of that in a little bit. Here's the 4-hour chart. There's 250 to 400 pips available on this move going down, starting in the green circle and going down from there. I mean, that's what we want to do. We want to get those big moves if we're looking at those longer time frame charts. So for people who are patient long-term traders, there are substantial pip setups that are available. Here's that bearish divergence example that we looked at earlier. We're going to go over these examples again because there were some questions about it. This is the 15-minute euro-dollar chart. Price is moving up slightly and down slightly on the Wallaby. So price is moving up slightly and the Wallaby's moving down slightly. That's bearish divergence. Bearish Wallaby divergence, step 1. You find 2 peaks on price when the pair is making higher highs from left to right. So step one, we're going to find two peaks on price from left to right. Peak number one, peak number two. Simple enough. Easy enough to do that. Piece of cake, right? Step 1.2 is we're going to draw a trend line across those two peaks. You're now already a genius and a divergence champion. That's the start. That's the first thing that we're going to do. Step two is we're going to see if these two peaks are also overbought on the regular stochastic oscillator. You could turn this into a drinking game and take a drink if that happens. So we go to step two and we see if these two peaks are also overbought on the regular stochastic oscillator. Peak number one is overbought, but peak number two gets close, but not quite all the way there. Well, close is close enough, and the judges will accept that. Entering the trade only has one step. When the regular stochastic oscillator, which is set to 30-10-10, shows a bearish crossover, we're going to sell. Here's a crossover. A crossover is when the faster stochastic line crosses over the slower one. In this example, in the next chart, our crossover happened after the divergence trade setup, and so we sell. Circled with all the arrows pointing at it is our stochastic crossover, signaling the entry to the trade. As soon as we see divergence and then see a crossover on the stochastic, and we get a close of the candle that creates the crossover, that's the trade entry on this methodology. That's the trade entry. Example number two, bearish Wallaby divergence. Step one, we find two peaks on price when the pair is making higher highs from left to right. I think what I meant to say, lower lows. There we go. Find two valleys on price when the pair is making lower lows from left to right. Oh wait, we're still looking at an example of bearish Wallaby divergence. Okay, so we're going to look at another example here. Find two peaks on price here in the purple circles. Here's two peaks on price from left to right. See if these two peaks are overbought, and they are, or close enough, overbought. So we draw a line across the tops of those peaks. Step three, we ask, is the Wallaby indicator making lower highs across the same time frame? And it is. In this instance, it's explicit. It's very clear that over the same period of time, even though the currency pair is rising, the Wallaby indicator is falling drastically. And that slope is very important. Entering the trade, we wait for that crossover. A good question arises, do these peaks with price have to match up exactly with the peaks in the Wallaby? They have to be pretty close. They have to be pretty close. They can't be that far off. So yes, they have to be within a few candles of each other. And you can bend that rule a little bit, but you won't want to bend it very much. So yes, they have to be pretty close. The crossover in this example, folks, happens before the divergence trade has even set up. So in this case, what do? In this case, as soon as peak number two closes, as soon as that candle closes at peak two, and it has made a higher high on price, it's good to go. The trade is on. Because the crossover already occurred, so it means the trade can be taken right away. Now, if that frightens you a little bit, because you're picking a top, which people say, oh my gosh, that's a terrible idea. Picking a top is so awful. Well, remember, anytime you take a trade, you're picking a temporary top or bottom. You're saying it's not going to go much higher than this or lower than this. It's actually going to go in the opposite direction. So everybody's always doing this constantly. There's no getting out of that. Waiting for divergence And waiting for a Wallaby trade is just a methodology for being patient about waiting for that. If it frightens you to take a trade because you're picking a top or a bottom, then just probe the market. Just take a small first trade on it and don't enter your full position size at the very beginning. And if it goes against you, then you just lose a small amount. That small first position might lose only maybe 1% of your total account balance if the trade goes wrong. All right, let's move on to an example of bullish divergence. Bullish divergence is created when a currency pair is falling with price, but rising on a Wallaby indicator. So you're a bottom feeder, right? You're picking a bottom. That's a great way to get a stinky finger, right? So you're a bottom feeder here, and you're going to pick a bottom when a currency pair has fallen and you don't think that it can fall any further. Maybe it's fallen and you've been in the midst of an upward trend. We're going to look at an example of that today, and that can be very powerful. Bullish Wallaby divergence finds two valleys on price when the pair is making lower lows from left to right. So in this case, from point 1 to point 2, the currency pair was falling. And then you see if these two valleys are oversold on the stochastic oscillator. Close enough. Point 1 is oversold. Point 2 is not, but it's close enough. Close is close enough on the rule about being oversold. It's okay to bend the rule, in other words. Sometimes the stochastic oscillator is going to get close to oversold, but not all the way there. All right. And now we draw a trend line underneath the Wallaby across the same period of time. And lo and behold, the Wallaby indicator is rising and the candles are falling. And that's an early warning sign that the currency pair could be ready to move back up. So you're going to drill, baby, drill. When the regular stochastic oscillator set to 30-10-10 shows a bullish crossover, it's going to be drill time. You're going to take a trade. And there it is right here. The crossover happens 10 candles after the divergence trade sets up. And that's good enough. And there you go. There's the entry candle shown where the arrow is pointing. And that's the entry on the trade. One simple step for a stop loss is to find a recent high or low and protect your account by setting the stop loss at that level. In this instance here, we simply set a stop loss directly below the recent candles. For those of you wondering what the input was for the Wallaby, we'll come right back around to that in just a moment. On a sell trade, the stop loss goes above the recent high candle. Wallaby profit targets. You can use a recent high or low. You can use a moving average. You can use overbought or oversold candles, or you can use a time-based profit. Here's an example of using a previous low support level as a profit target. In a trend trade, you might just use a trailing stop because the recent trend was down in this example, and then the currency pair set up divergence going south. You might use a trailing stop on a trade like this. Your trailing stop could be anything that you make up. I don't use a trailing stop, so I can't even speak to that for you. In this example of a buy trade, the profit target could go at this previous high. It doesn't make it there, but that would be an example of a profit target at a recent high for a bullish trade. Here's a euro-dollar 4-hour chart, sell trade. And as you can see, the 800 simple moving average was a good profit target. We'll look at that actually also a little bit later today as well. And that example comes later. All right, so in a moment like this, you're probably going to have questions about what we've already discussed. So we're going to take a moment now, where this ends part 2 of the Wallaby Trade presentation video. And what we'll do next is we'll go back and we'll review some of the concepts that we reviewed earlier, just to make sure that you've got it all under control. All right, let me look at some of the questions that came in. We'll pause for a moment, like I said. How long after divergence is a crossover no longer valid? Would it be wise to stack a divergence trade to maximize profit? Okay. All right. Let's go over a couple different things here. The Wallaby indicator is going to be set to 733. The stochastic oscillator will be set to 30, 10, 10. If you are a short-term trader, you would probably look at the 1-minute chart, the 5-minute chart, and the 15-minute chart and set your Wallaby indicator to those times. And then watch the 1 or 5-minute charts for trade. If you're a medium-term trader, you'll probably look at the 15-minute, the 60-minute, and the 240-minute, and then watch the 15-minute chart. You could also watch the 30-minute chart here. And pay attention now, because I'm not going to repeat this again. All right. Long-term traders would use the 60-minute, the 240-minute, and then the daily chart, the 1440-minute, and then watch the 60 or the 240-minute charts. Stacking trades. If you live outside the U.S. and have more leverage available, stacking trades could still be a possibility on these trades. But if you're inside the U.S. and you have less leverage available to you now, I would not recommend that. Things could get bad in a hurry. Okay, let's see here. Move on to some examples. All right, Fernando asks an interesting question. In all of these charts, Rob, the Wallaby does divergence, but so does the stochastic oscillator. Please elaborate on the contribution of the Wallaby trade given that. Fernando, you must have missed the beginning of the webinar today, or your ears fell off, or I don't know, something like that. About 50% to 60% of the time, divergence will show up on the Wallaby and any other oscillator that you look at. About 50 to 60% of the time. Other parts of the time, it will not show up on some other indicator, but it will show up on the Wallaby. In this example from February 28, 2011, the stochastic oscillator at the bottom doesn't really show divergence clearly. It's just sloping downwards across the top on an overbought stochastic oscillator. But the Wallaby clearly shows two peaks that shows divergence much more clearly. And that's a good example of when the stochastic oscillator doesn't show divergence at all or doesn't show it clearly, but the Wallaby indicator does. In other instances, Fernando, the Wallaby indicator will not show divergence, but another indicator will, and you'll stay out of a trade. And that's the reason I use it. However, there's nothing magical about this. Remember, I'm not here today to say it's magical. I'm here to say it works better for me for the reasons I've just discussed, but plenty of people could use the moving average convergence divergence or the relative strength index or the commodity channel index or other indicators. All right. Here we go. Let's look at the next example. Remember, the stop loss goes above the recent highs on a sell trade. The profit target could go at a moving average. That has worked very well. And then the currency pair falls down to the 200 simple moving average. In this example from March 1st, 2011, the currency pair is rising and the Wallaby indicator is falling. And the 800 simple moving average could be your profit target, circled in green. Stop loss above the recent highs. And in this case, the currency pair falls a great deal, but doesn't fall all the way to the 800 simple moving average. It did fall to the 200, but didn't get to the 800. Just some things to remember here. March 4th, 2011, price moves higher. The Wallaby indicator moves lower, and it gives a warning sign that this currency pair could fall. It'll stop out if it goes above those highs, and it'll take profit if it falls and reaches the 200 simple moving average or so forth. Here's March 2nd, 2011. In the midst of an upward trend in the euro, it had been going up for at least the past week. On the short time frame chart, the euro was falling on price underneath this little Simpsons character picking his nose, but the Wallaby was rising, and it was a great trend trade. And we'll look at another trend trade just a little bit later on this morning. All right. Do I use any other indicators together with the Wallaby for confirmation? And the answer is no. Okay. Somebody asked what the inputs were again. You must be watching porn while we're doing the webinar, because this is now like the 5th time. The question is, does the input for medium term is 1560 and 240? And watch the 15-minute chart. The answer is yes. I'm going to wait 5 seconds so that you have enough time to type in that same question again. Okay, here we go. I'm going to look at some examples from today. I'm going to pause screen sharing. This would really be a good place to end part 3 of the webinar. Pause it for a moment, cut it off into a section, and then come back, and we're going to look at some examples from just actually the last day, and I'm going to answer some questions about recent trading on the Wallaby. Philip says, in bearish Wallaby divergence, does peak number 2 always have to be higher than peak number 1? Or at least the same? Or at least, the total same amount? All right. I'm going to show my chart now. In part 4, we're going to look at some recent live examples of the Wallaby trade. I'm going to answer some questions about recent trading and in 2011 on the Wallaby. Question about the book being available for iPhone. You could just download the Kindle application on your iPhone, and then in a few days when it's available for the Kindle, you can buy it for that. So the answer is yes. All right. In this example, this is the 15-minute chart. I'm going to show you the most recent example of Wallaby divergence on the 15-minute chart. Here you go. The currency pair on the 15-minute chart made higher highs on price after the big gap on Sunday, and at the same time was making lower highs across the same period of time on the Wallaby indicator. And we're going to look at last night's trade first. Then the stochastic oscillator crossed over here in this pink shaded area, and that was the sell trade. The stop loss went above the recent highs, and the profit target went down at the 800 simple moving average. And that is an example of a profitable Wallaby trade. That's an example of a trade that I actually took. It was actually the best trade that I've taken in a couple of weeks, actually. That's exactly what a profitable Wallaby trade looks like. All right. I gave Capima enough time to type in the same question again, and sure enough, the question was typed again. Capima says, it is not clear the input yet. Okay, so everybody cover your ears, because this time I'm going to yell it. Capima, I'm not going to finish this webinar until you get it. All right? I'm not going to leave here. If I have to stay on this webinar all day, for short-term traders, the input is 1 minute, 5 minute, and 15 minutes. You type in 1, 5, 15. 1, 5, 15. 1, 5, 15. 1, 5, 15. 1, 5, and 15. That's the input and the time frame charts. Sorry, everyone. Now there'll be plenty of time for you to retype your question again. Okay, so I did take that trade, and as you can see here, I got in at 39.85. I hope you're looking at that. I got in at 39.85 and I closed it out at 38.84. I actually stayed in even longer than the 800. It was 101. It was 101 pips. Can you see that, everybody? Everybody see that? Okay, great. So now I want to show you the losing trade right here. You'll see it right here. 39.47. I lost $388, $776, and $778 on these ones right here. And I'm going to show you that losing trade next. So here, I'll show you the losing trade now. Before this winning trade occurred, and this is very common, you have a trade setup that doesn't quite work out. And here was divergence before the winning Wallaby trade. Currency pair made higher highs on price, lower highs on the Wallaby. The oscillator crossed over right here, and I sold it. And I stopped out when the currency pair went above the highs. And so I took a smaller loss. You can see I took a 38 pip loss in exchange for about a 90 to 100 pip gain. And that risk to reward is common. That's common. I could have even taken a smaller loss on that trade. But they do lose, okay? I mean, there are losing Wallaby trades. There's plenty of them. You'll notice here that I was trading against the trend. The currency here was going up and I was selling it. And it has been going up for a long time and I was selling it. And so that was, this is definitely a counter trend trade. We'll look at a trend trade in just a moment, but this was a counter trend trade. Let's look at that trend trade now. Overnight, the currency pair fell. I was in a sell trade. It hit the 800 and went lower, and the currency pair showed price going lower and the Wallaby indicator going higher. That's bullish divergence. What it also had going for it was that the currency pair has been in a pretty substantial upward trend on the longer time frame charts. Right? It's been going up. I mean, clearly up, right, everybody? I mean, obviously clearly up. Up is the trend. And so you could buy the currency pair when the bullish crossover occurred and stay in for the 200 simple moving average, or even higher because you're trading with the trend. And that would have been a profitable trade. I did not take this trade. I was asleep when this trade set up. I was also short when this trade was setting up and still getting out of my sell position. Now, if you look at the chart currently, what do we have going on? We have the currency pair making higher highs on price and lower highs on the Wallaby. And what are we getting right now as we're talking in this very moment? We're getting a bearish crossover of the stochastic oscillator. Now, am I going to take this trade? And the answer is no, I'm not going to take this trade. This is clearly against the major trend. I know that every spec in the world on the COT report is long the euro, and everybody says that that's going to make the euro go down. And trends always last longer and go farther than we think they will. And what I would prefer to do in this instance, folks, is wait for the currency pair to come out of overbought on the stochastic oscillator. I'd prefer to wait for that. And I'd love to see if we can get the pair a little bit higher before I would take this trade, because it's against the trend. It's against that major uptrend. And you might think the trend is over, and that's perfectly fine. You are entitled to your own opinion. But I'm going to wait a little bit longer on this one because it's against the trend. And I typically specialize or prefer the 15-minute chart. It's my preferred Wallaby time frame. It's where all of my testing on the Wallaby trade occurred. And it's my favorite time frame to watch. And we are not divergent on the 15-minute time frame. All right. Which session will be more profitable, New York, London, or Tokyo, is the question. There is no one session that's more profitable than any other. However, at 6 a.m. Eastern Time, 6 a.m. Eastern Time, you get a lot of 5-minute Wallaby trades that set up. If you're a 5-minute Wallaby trader, a short time frame trader, 6 a.m. Eastern Time, well, between 5 o'clock in the morning and 6 o'clock in the morning Eastern Time, there's just tons of them that set up. That's perfect. All right, let me answer a couple questions, and then we're going to look at a bunch of examples. Why has my trading personally been poor this year? Has it been the Wallaby, or has it been something else? The answer is the Wallaby trade itself has been very profitable over the course of this year. And remember, trading is risky and past performance is not indicative of future results and so forth. My own personal trading suffered from a lack of focus and from staying in a couple losing trades longer than I should have. Just common mistakes, common stupid mistakes that I shouldn't have made. Had nothing to do with the Wallaby or the pivots or the Arizona rules or anything else. Just really disappointing performance from myself at the very beginning of the year. Just really bad. I had a great end of the year. I had a great December, and then I had a terrible first week in January, and it had nothing at all to do with the trades. If I had just simply taken the 15-minute Wallaby trades and stopped out when I should have and taken profit when I should have, we'd be having a completely different conversation. Ricky says, does that mean I haven't been disciplined in my trading so far this year? Yeah, that's exactly what it means. It's just been a tough year for me at the beginning. We all go through periods of time like this, and I've been through my period of time now, and that time is over. But I had a difficult time. It was a rough stretch. Do I ever start taking stuff off the charts when I'm having difficulty? No, what I really do is I just take a break, and I try to pull my head together and take a break and stop. Try not to compound it. That's what happens. Okay, I thought you counter trend trade also, Boyke says, so why not take the trade now? Because, Boyke, I really wait for the 15-minute charts. This is really what I wait for, and that's the key for me. If this were a 15-minute chart trade, I'd be more willing. All right. Other questions have come through, and we're definitely going to take a look at those questions. Let me pull up Microsoft Excel spreadsheet here, and we'll take a look at see if I've got this spreadsheet up. Yeah, here we go. This is going to be a big screen share, so I hope this works. All right, you're looking at a spreadsheet that has approximately 160 trades on it from the 15-minute chart. 87 winners, 69 losers. Average win was $6,632. Average loser was $3,600. Overall, we got about a average winner 2 times bigger than the average loser, or a little bit worse than that. Just a little bit worse than that, and a better than 50% win percentage. The losing times for this methodology tend to be the summer months in testing. That August month where the market is thinner, volatility is whacked, trades tend to stop out. And this is Wallaby testing. You already looked at my live account today. This is Wallaby testing taken with the same trade sizes that I take the live trades with. So this is an example. This is a lot of testing. I'll post this testing up on the web so you can see it. And I have a chart to accompany every single one of these trades. I have a chart. And I'll show you some of these charts right now. I will post all of these charts as well. I have 266 screenshotted, saved examples of Wallaby trades for you to see. This testing is not automated. It was all done in Forex Tester by hand. All right. My testing period stretched from 2009 to 2011. And Chris, if you're going to automate any of this or program it, I'd love to be a part of helping you do that. So stay in touch with me on Twitter as you do, and we could even work together on some of that. I'd be happy to help out with some filters and other things for automated trading. I'm going to look at some examples of this together with you right now, and we can look over and you can ask some questions about what we see. So this would be, I guess, part 5 of the webinar. We're going to take about 10 minutes, and I'm going to show you just a bunch of these examples. Remember, I'm going to upload all of these examples to the blog that I'll talk to you about in a moment, and you'll be able to see, download, and look at all the testing and all the screenshots of the Wallaby trades over the past, 266 of these trades. In this example, the currency pair made lower lows with price and higher lows on the Wallaby, and the trade stops out. It's not a surprise that the trade stops out, folks. The currency pair has been falling from left to right, so this is a counter trend trade. In this next example, it's absolutely clear. This is the very next example. The currency pair has been falling, and the Wallaby indicator is rising, and once again, the buy trade stops out. It's against the trend. And remember, the system, even with the counter trend trades, in its testing was overall profitable. However, it changes a lot if you just keep it to the trend traded examples. All right, let's look at some of these examples. We're going to go way back farther. Here we go. Here's an example of the currency pair falling and the Wallaby rising. Once again, a buy trade stops out. Here's an example of the Wallaby rising on the bottom, price falling down here. A buy trade goes all the way up to the 800 simple moving average. And as you can see, the profit target is more substantial than the traditional stop loss. The stop loss is going to go right down here below these lows, but the profit target's way up here. That's the kind of stuff you want. Here's an example of a ridiculously counter-trend trade, right? It is so clearly against the trend, and it stops out. No surprise. All the testing includes these examples of stopping out. Now the currency pair has started to range, right, and go up. On the left-hand side of the chart, the currency pair is rising. So when it falls down here and creates bullish divergence, this is a trend trade. And not surprisingly, this trend trade reaches the 200 simple moving average. In this example here, the currency pair is falling and the Wallaby is rising. I actually stretched the trend lines a little bit too far. A buy trade almost got to the 200, but then stopped out. Here's an example of a currency pair rising from left to right. The currency pair then falls on price and rises on the Wallaby and reaches up to the 800 simple moving average and further. If you stop out of a trade and the divergence shows up again, it's just a whole new trade setup. The question you have to ask is, are you going to trade the first time when you see a counter trend Wallaby trade? Or are you going to skip that one? Just simply skipping the first example of counter trend divergence is the filter that I was going to mention to Chris. just skipping that first one. There is no charting package that is more accurate for the Wallaby. There isn't just one charting package. I really like TradeStation and I really like MetaTrader. In this example of the 15-minute chart, price is falling, the Wallaby is rising, and a buy trade gets up. This is an early close. I don't know why it's closed here on that example. I don't know why that's closed there. It made it all the way up to the 200. I don't know why that trade closed out there. In this example, at the bottom of a trend, the currency pair is falling, but the Wallaby is rising. That's bullish divergence, and it makes it to 200. Once again, you might skip some of these counter trend trades. In this example here, the currency pair is rising from left to right and falling on the Wallaby, and then it makes it down to the 800. Both of these examples from trade number 58 and trade number 59 are actually profitable. And you can see that one makes it down to the 200 and the next makes it down to the 800. Masakazu asks, is it better to look for the trend trades? I think it's better to test and try out the trend trades. This is a good example. Look at how many trades stop out. 1 stop out, 2 stop out, 3 stops out, 4 stops out, until number 5 is profitable. Now, even with all of that, once again, I'm going to repeat myself. Even with all of those stop outs, the system actually had more winners than losers, and the winners were bigger than the losers. However, just by avoiding the first counter trend trade in a series, you can filter out some of the stop outs. Here's an example of the currency pair ranging around the 800 simple moving average. The currency pair had been falling from left to right and then sets up a sell trade. Currency pair rising, Wallaby falling, even slightly. Sell trade gets all the way down to the 200. So all 270 plus examples will be uploaded to my blog, and I will make those examples available to you. And they'll be in some kind of a gallery on the blog, and you can look at them and refer back to them, and I'll put them in groups of 10 or something like that. I have to figure out exactly how I'm going to do that. Here's how you get more information about the Wallaby. Let's go down here or up here. All right, here's how you get more information. All right. You can go to fxstreet.com and download the indicator. Maud posted some links to that earlier. You can also go to rob.bz. That's my blog, and on my blog, you'll find examples of Wallaby trades. You'll find indicators. You can also go to the Wallaby blog, and this is where I really recommend you go, at wallaby.me, wallaby.me. I'll pull up these blogs in just a moment as well. That blog has the indicators for all the charting platforms, and will have all of the screenshots. I can't believe somebody's asking if the webinar is going to be recorded and posted. I can't believe that. It would be the only one in the history of webinars that FX Street didn't post. Okay, you can also follow me on Twitter. You could follow Wallaby Trade, at Wallaby Trade on Twitter. That's a place to get all the Wallaby trades. And you could follow me on Twitter at Robbie Booker. These are all places to get more information. But where do you get the super most amount of information? Where do you get the hugestest, super biggest, giantest amount of information? You get it from the book. And the book is The Wallaby Trade. It's $10.08 on Amazon, and selling well. Would love for you to look forward to you reading the book and having questions as you read it. I'm happy to stay in touch with you in all of those other places that I just mentioned as well. All right, Maud, I think we've wrapped it up here. I think that's the conclusion of the webinar today. If there's unanswered questions, go to the blog go to Wallaby blog or follow the Wallaby on Twitter and ask a question in that forum, in that area. Appreciate you all being here. Thank you very much for taking the time to learn about the trade. Look forward to spending some time with you as you trade this. One last question that came through is, how do I get the one line on the Wallaby? Looking at the charts here, you right-click on the Wallaby and you click on Settings for Colors, and you make the first three colors transparent and the last color, whatever color you want the one line to be. And that's how you get that. All right, everybody. Remember, the Kindle edition will be out in just a few days, and look forward to you reading that, and look forward to you asking questions about it once you do. Thanks, Kyle. That's hilarious. I had a really good time. Thanks for your questions. Thanks for being here. Sorry if I didn't get to your question, but I'm happy to answer it later. Have a great day, everybody. Please buy the book. Looking forward to you reading it. Thanks, Maud. Thanks, Adinda. Have a super day.